To the second lecture for Chapter 6. We're going to talk about inventory methods in this lecture because we've talked about the fact that revenues when we sell our items, whether we're a merchandising company or manufacturing company, it's going to be reflected in what people are paying us for them. And this cost of goods sold should always reflect what the items cost us. But let's just stop for a second and think about how hard that can be. If I buy 100 pieces of candy because I'm opening a candy store and I have different prices I've paid for each of those pieces of candy, all the candies are sitting in a bin, how do I know which piece walked out the door when I sell it? So we're going to talk about how we figure that number out. Before we do, I want you guys to focus on, put a big star by this page. This is a multi-step income statement. Now, it's the same income statement that we've always seen, but in this case, it's for a manufacturing or merchandising company, and it's got some subtotals that are important. When you put together a multi-step income statement, you need to make sure you get that gross profit number. As I talked about in video 1, that's the difference between what people were willing to pay me for my products and what I paid for the products. That number needs to be positive to run a viable business. Then I'm going to have some other expenses and have a new subtotal called operating income. That's another important number that financial analysts like to look at when they're assessing the health of a company. Then I'm going to have some additional income and expenses, income tax, and down to net income. So in your practice sets, you should be practicing putting these together. You're going to want to be comfortable knowing how to put the different subtotals in along the way. All right, but let's really get into this cost of goods sold. So remember, if I sell units, when I purchase units, I'm simply going to increase the asset called inventory, and I'm going to increase or accounts payable or decrease cash, however I choose to pay for the balances. When I sell my things, the first part of the entry doesn't change based on inventory method. It's always the same, right? It's a little star here. I'm going to debit accounts receivable or cash for what somebody was willing to pay me, and I'm going to credit revenue. Now when I remove that inventory from my balance sheet and I record the cost of goods sold, the debit to cost of goods sold and the credit to inventory, using those accounts never changes. What changes is the amounts we use, and it's driven by the method. And I have 4 different methods that I'm going to talk about today. Specific identification, FIFO, LIFO, and weighted average cost. Literally, companies just pick. They just say what makes sense with the way that our goods flow and which inventory cost method are we going to choose, and we're going to use that every time we make a sale. Companies have to make those choices. It's very hard to justify changing the choices after they're made. So specific identification is probably the easiest one. So that is simply where, I can track the exact good that I purchased and the exact good that I sold. So I don't have to guess what I paid for it, right? You would see this like with diamonds, right? If I was a diamond broker and I went out and I purchased a diamond for $50,000 and I purchased another diamond for $1,000, right? Well, a customer comes in and buys, right? We'll call this diamond 1. And we'll call this diamond 2. If a customer comes in and purchases diamond 2, well, that's going to be my cost of goods sold and my reduction in inventory. I'm not going to try to guess or come up with an average. So I'm specifically identifying the diamond that I purchased into inventory versus the diamond that I sold. That's probably the most logical one that you can come up with. The rest of them are where we're just going to make assumptions about where things have flowed? Can't speak today. Have left our balance sheet. So let's start with Mario again. We've got his beginning inventory, we've got purchases, and we've got sales. So pay attention to a couple of these numbers. I've got 1,000 units available for sale, right? Made up of my beginning inventory and my purchases. I paid different prices for each of these, right? I had $7 unit costs on my beginning inventory. When I did my purchases in April, the cost rose to $9, and on October 19th, the cost rose to $11. So we're going to assume that Mario cannot specifically identify which toy he sells when a customer comes in and purchases something. So we know he sold 800 of the 1,000, and he's got 200 left. But the question is, which 800 did he sell? Did he sell the ones that cost $11, the ones that cost $9, or $7? He has to decide on a method. So the first method is FIFO, and FIFO stands for first in, first out. First in, first out. And what we're assuming is that the first units that came into our inventory are the first units going out. So we said before, we know we've sold 800. So let's put 2 columns next to our data and start moving things over. So I'm going to take the first 100 units at $7 and call that cost of goods sold. So that's 100 of my 800. Now I'll take the 300 at $9 and move that into cost of goods sold. Now for this last 600, I can't use the whole thing, right? Because I've only sold 800 of the 1,000. So I'll split it. I'll take 400 at $11 and put that into cost of goods sold. Then my remaining 200 in ending inventory, which is also at $11, ends up in ending inventory. So notice this, right? Your cost of goods sold plus your ending inventory always equals your entire available for sale. You're just slotting numbers into whether they end up in cost of goods sold or ending inventory based on your method. Since this was first in, first out, or FIFO, we're using the first things in and assuming those are the first ones to leave. If we contrast that with LIFO, which is last in, first out, it's exactly the opposite. If you can understand LIFO, you can understand FIFO and vice versa. So here we'll start at the bottom, and we're moving the pieces at the bottom over to cost of goods sold. So we say, yep, this 600 is over here, and we just need to get to 800. So we're going to take 200 out of that next block and move it over. And then the last 200 ends up in ending inventory. Again, cost of goods sold plus ending inventory still equals available for sale. But let's look at the impact. So when we used LIFO and prices were going up, our cost of goods sold was $8,400. When we used FIFO, right, we assumed that the older stuff, the first ones in, are the ones that sold. So you'll notice our cost of goods sold is $7,800. So the choice of LIFO versus FIFO can be really impactful to a company, depending on what their cost of goods is happening. Right now, my understanding is that raw materials and lumber is extremely expensive. So I would imagine if we looked at Home Depot, we would read a lot about whether they're using LIFO or FIFO and how their sales of all of that timber is actually impacting their cost of goods sold. So we'll talk more about that in class. The last method is called average. And let me get to the right slide on here. That was LIFO. Here's average. Average is in some ways the simplest. LIFO and FIFO are identical. They're just inverses of each other. Average says I'm going to wait until the end of the month. I'm going to look at how many units I had available for sale, which is 1,000, how much the total cost was. So I don't care about this middle information, right? So I'm going to divide the $10,000 by the 1,000 units, and I've got a cost. And I'm simply going to apply that cost. I'm applying it to the 800 units sold, and I'm applying it to the 200 units not sold. So I end up with $8,000 of cost of goods sold. I find on tests this is the one that trips people up the most because it's almost so simple, people don't practice it or forget how to do it. So take some time, make sure that you practice all 3 of these. That will be the most important thing for this chapter. So I will come back and do one last video associated with what we do when our inventory values drop.